Okay, we're now live, which is great. Good morning, everybody. It's 1 minute past 11 o'clock, 10 o'clock. I'm sorry for the slight delay. Daniel Mundy is here to join us. Thank you for joining us, Dan. Mundy
Morning.
from the 3% Club. I'm Simon Campbell from Investing Expos, IX Trader Show, London Prop Trading Expo, and of course the Round the Clock Trader webinars. Kind of nice to be doing this again because I spent many years doing these monthly events, and we kind of got distracted with shows and stages and banners and all that sort of stuff, and I neglected the online events a little bit. But this is us getting started again. And quite excited to do it. It's quite nice to be here, back in the seat. No planes, no checking in. I think so. We love in person, but online is great. As long as it's live. Daniel Monday's our first week, and I must give you a special thanks, Dan, for stepping in fairly last minute. We were expecting Ross Maxwell to do this. Unfortunately, he's ill today. So I contacted Daniel yesterday, and he agreed to move his diary around and join us for this webinar. Daniel, it's good to see you again. I know you talked at the event in London, and your approach to trading is that of a sort of mechanical system. You run the data, you look for consistency, and that repetition is what actually earns your income. So we'll get on to the presentation. I know you put some presentation together for us this morning, which is great. Just to welcome everybody here. Hopefully you can hear and see both Daniel and myself. We had a couple of issues getting logged in ourselves this morning, so I hope it's all been smooth running for you guys out there. I can see greetings from Boris, and Ashok is there as well. So just let us know with that chat box. If you can see the little comments chat on the right hand side, you can open that up for the live chat. And I guess we like questions, we like live chats. We are live here Thursday, 29th of May. I don't know what's happening. I did catch the news to say there's been some sort of court ruling on Trump's tariffs, so I imagine that's going to have an impact on the markets today. But let's get started. We've got a range of speakers. Daniel, maybe you could begin by just telling everybody a little bit about your background, how you sort of fell into being a full-time trader now, I guess.
Yeah.
We can go on to look at the way you trade.
Yeah, absolutely. Thanks, Simon. So, hear me loud and clear. So, 2012, I learned from a chap called Robert Dunn. I know when I spoke at the last expo, there was a few people in the audience that had learnt with him as well, which was quite special because he actually passed away a couple of years ago. But he was an ex-Goldman Sachs trader, worked on the floor of the CME back in the day, and he taught very simple supply and demand concepts. So I learned the right way from him, before all the noise of Instagram, social media, the TikTok trader kind of Lambo lifestyle. I was lucky enough to be taught the right way and a realistic way. But what followed was 4 years still of losing money, learning things about myself that I never knew because trading psychology is so difficult to grasp. And even though I had a system and I had an edge, I typically do the classic thing of losing a couple of trades, think, what am I doing wrong here? Try and break the system down again, go back to the drawing board when all you need to do is just execute through those periods of drawdown, and eventually the edge plays out. But it takes all of us a long time to realize that, I think. And then by 2016 to 17 is when I took trading full time. So it took me, that 4 or 5 years to get to a position where I could then trade for an income, because it was overtaking my job income. But then what into was the most stressful year of my life, trading full time for an income all of a sudden.
Everything changes, doesn't it? When absolutely. You can't find that check coming in at the end of the month. Yeah.
Absolutely.
Were you in financial markets? Were you in investment banking or anything? Any background in that before?
Not at all. So it all came about in a funny way, really. I did economics at sort of A level, and I had an interest in that kind of thing, but that wasn't my degree. My degree was sports based, so it was nothing to do with trading. but I actually had a friend who had lost a lot of money through the Northern Rock collapse back 2008, and he was putting a lot of money into gold as a hedge against a potential another crash. Because he was scared of what happened the first time. He felt like he wanted to siphon 20% of his income into gold, and he started getting me on that path. And it wasn't long before I realized, okay, I can look at a gold chart, but I can also look at 100 other charts here, and there's a lot going on, and there's potential in these markets to learn something. So it all developed into that. And I think I'd always been interested in it, and it was on my radar. And if I had my time again, perhaps I'd have pursued that avenue through a degree or something. But having said that, I'm not sure how much I'd want to be working in the city as a full-time trader anyway. So it all sort of
Well,
works out well.
making money for other people sometimes, yeah, but you, being a self trader means that you can sort of manage your lifestyle, which is the ultimate, isn't it?
Yes, the
So,
freedom. Yeah.
so tell me, did you start off trading your own money? Did you put your own capital into
Yeah,
accounts?
I did. Yeah. So, this was before the days of the sort of the retail prop firms, or what I call simulated prop firms nowadays, because we all know that they're not, real capital. But um, so the barrier to entry was how much have you got to put in an account at the time. So it was very
Yeah,
different to now. A lot of people can get started with a half decent prop firm. I know some of them aren't the best, but others are great, and get paid consistently quite quickly with a low barrier to entry. So back then, yeah, it was my own small money. I traded that for years, built it up, saved more from my job, and eventually built a reasonable pot up that I could then kind of take full time. But as soon as I took that full time, I mean, I've talked about this on a number of podcasts. It was just the most stressful year of my life. I nearly had a mental breakdown. I'm pretty chilled as a person, but when you're suddenly trading to pay a bill, I mean,
yeah,
you can't trade like that realistically. You've got to trade what the market gives you, not what you want the market to give you. So
right. Yeah,
you're sort of forcing things to earn, and it wasn't the way. So by 2018, I got offered an opportunity to trade for a firm, which worked out quite well, and I did that through the course of the year. It took a lot of stress off. Did some educational stuff for them as well, which was great, and then went back to just trading on my own by 2019. And we got all the way to COVID. It was actually 2021 where I had a few friends that had been off work through 2020 with the furlough schemes and things, and they asked me to show them what I did. So I popped them in a Discord server. We talked every day about what I was looking at, and they learned from me. And then before you know it, we had about 20 people in there of their friends referring people, and I ended up calling it the 3% Club, which was the play on the fact that we're the 3% of traders that can make money. Obviously the stats vary between 10 and 5% or whatever, but that's now grown to 50 mentees, and I've got 50 people in the group that trade with me every day. We all trade the exact same edge together, and I'll talk a bit about that with the
yeah.
presentation I've got, and how we look at the markets.
Fantastic. Thank you for that. I mean, data-driven trading, why I believe mechanical trading is the key to finding consistency. And yeah, I mean, it's a great title. It's what we all kind of hanker after. Um, but in order to be mechanical, you've got to kind of shut off your emotions, don't you? in,
Mm,
in a way. So you're trying to do something which is not necessarily intuitive for us as human beings. So
mm.
maybe you can cast some light on how you do it, and I'm sure everybody's got slightly different approaches. Let's think about sharing screens. It's the next little technical hurdle for us to get over. If I guide you to your mouse, it may be if you above your head on the screen, you'll see a range of options.
Let me know if you
Oh,
can see
it's
that.
found it already.
Okay.
Professional. Yes, I can see that now, which is great. If anybody at home can just give us a yes in the chat box to let us know that you can see Dan's black slide with the white writing, and that would be great. Okay, we'll assume that everybody is okay for this. So yes, great. Thanks, Ashraf. Data-driven trading. Okay, well, I'm going to step back a little bit, hand over the stage to you, and and let us learn a bit more about data-driven trading. Keep the questions coming, folks, and I can liaise with, I can sort of mute it and speak to Dan, and then we can see where we are at the end for some questions. But in the meantime, I'll hand over to you.
Sure. Thanks, Simon. So data-driven trading is an open-ended thing. People can look at data many different ways. And what I find working with a number of traders is that even if they have a profitable edge, they don't necessarily have it quantified. So they can't tell you the ins and outs of their edge. They can't tell you their unrealized gain, their average drawdown, their overall strike rate. Some can, but many can't. And what we find in the 3% Club, or what I find mentoring new traders, is that a data-driven mechanical edge is the best way to teach someone getting into financial markets. There's a couple of reasons why, and we'll go into those as we progress through the slides. But before we start on that, what is discretionary trading? This is the other side of mechanical trading. So if you're a mechanical trader, you've got a data-driven tick box process where you take a trade based on a number of things aligning. If it fits the bill, you take the trade. But discretionary trading, and you'll meet a number of discretionary traders probably in here today that are fantastic traders. But what it tends to be based on is experience, intuition, judgment. Some of these guys will have years of experience in the markets. And sometimes what you find is, and I don't know if any of you have found this, but when you bring a mentor, when you work with a mentor, there's certain things that they see within the markets that perhaps the new trader isn't going to see. If they've had 20 years of market experience, they're going to be making judgment calls that are just based on that experience. So it's very difficult to teach that to the new trader without time in the market, unless they put 20 years in and start to see the market in certain ways. Sometimes traders will say they think something is going to go up or down. They can't necessarily say why, but they think. It's really difficult, again, to teach that process of thinking why something would go up or down. That is trading, essentially, is trying to decide whether something's going up or down and getting on the right side of it. But mechanical trading is just technical analysis applied systematically. So that doesn't necessarily mean that it's algorithmic, because an algorithm is mechanical, but there could be elements of discretion within a mechanical system. There could also be things that are difficult to quantify in a mechanical system that you can't automate. So that's kind of where we are in the 3% Club. We have a mechanical system. It's very easy to teach. You teach the new trader. Within 3 months, they can be executing our mechanical system confidently and making money successfully. But there are a few elements to learn within it. So the issue with discretionary trading and why most traders struggle. So we just mentioned that it takes years to master. The other thing is the subjectivity of the system. So if you've got a system that's got questions, there's discretion within the system, and you're a new trader, it becomes very difficult to answer it. You could have one person looking at the same market, trading the same edge, but the element of discretion or subjectivity within that system generates two different answers. For example, bias. You may have a higher time frame bias that is long, but someone else may have a higher time frame bias which is short, and you're looking at the same thing. It's difficult because there's too much discretion within the system, too much subjectivity. The other thing is emotions interfere more in a discretionary system, because you have to think about where you think the market's going. And what that then leads to is fear, hesitation, most commonly, because you question whether your analysis is correct. With the mechanical system, it's, does it have this, this, and this? If it's a yes, yes, and yes, we take the trade. If it's discretionary, we have to think about what's the bias here. Have we seen what we need to see? Have we got cross-currency correlation? There's a number of different things that come into a discretionary system, which might be or might cause hesitation. And the other side of it, then, greed or overconfidence, right? If you don't have mechanical targets, then you could try and push a trade too far and end up with a loss, or vice versa. You could be cutting the trades too short. So the subjective questions, and I'll show you a couple of these now, and we'll look at a couple of charts. But if we go to this chart, for example, you could be a trend trader, right? And something that you look at within your discretionary system is the trend. Now, if we look at this, this is the Nikkei, or the JPN 225 Japanese index. We look at the trend here. We can say quite confidently that the trend is up. I think pretty much everybody in here would agree with that. If we go to this market here, it's a bit more subjective. You could say, well, it's range bound, it's sideways, but would one trader perhaps say, well, actually, no, it's in a downtrend because we've started to break structure to the downside in the recent price action. So again, it becomes a bit more subjective. And when we were at the traders show last month, I asked the audience what they thought of each of these, and each one generates a different answer other than that first one. And this one again is a bit subjective. You could say the overall trend is up because long term it's up, but we've broken a recent leg of structure again there to the downside on that. There was a big gap to the upside, then a huge drop. This is on the dollar CAD. Or you could say it sideways. We've fallen into a range in the last sort of few days, last month or so. So again, it becomes quite subjective. And I find this is difficult to teach to a new trader. It just leaves them really unsure of what they're doing, what they're looking at, and it leaves a lot of self-doubt. The mechanical trader, sorry, and that's slightly placed in the wrong place because I'm using a different format here, but is the rule-based trader. So it's a rule-based system with minimal subjectivity. There's very little discretion. It's robotic, and we focus on data. So inside the 3% club, we focus on just building the data, filling out a spreadsheet, taking the trades over and over. One thing that you've probably all heard is that one trade means absolutely nothing. And it's true. 100 trades will give you a probable outcome based on your edge. But one trade, you have no idea whether that's going to work or whether it's going to lose. Same with the next 5 trades. And we'll go into some data to see what consecutive losses you could face with different systems, because not being aware of that is really, being aware of it is very important for the trader. So just an example of how we log absolutely everything within our community, even more so than this through various other spreadsheets, but we can quantify everything that we log, and there's a number of other columns here on these spreadsheets as well. So the reason that data is so important and building data on your edge is that, one, it builds confidence. It gives the new trader conviction that the edge works, because if they haven't got any data, they're simply trusting the person that's taught them the edge, that it makes money. Well, we all know in this industry, there's enough people selling courses and God knows what that can't actually make money. So how do you know who to trust? Well, yeah, verified track records is a great thing. If people can prove that, then you've got a reason to trust them. But actually seeing the edge play out itself and you building the data gives you so much conviction and confidence in executing it. You've also got the ability to refine. So every quarter in the 3% club, we break down all the data and we look at what's working, what's not, what's our average drawdown, what's our unrealized gain, what time of day are we executing best? Are we executing better outside the average true range of the day or in a range? There's various things that we look at and we quantify and we can draw conclusions from. And if I look at some of my data at the moment, I know I'm leaving some profit on the table because my average expectancy from any trade is 2.3R. So, and I may have taken through the quarter 2R. So I've left 0.3R on average on every trade across the quarter. But having that data is so important because I can then make the changes and make the refinements. And if data wasn't important, then we would all still be trading the systems that the traders used back in the 80s, which, we know the market evolves, it changes. It's changed a lot this year, even from last year. So the market is a ever growing entity. We need to grow and adapt with it. Building the data also gives the trader a focus. So, if you turn up every day and your goal is just to fill out your spreadsheet, before long, if you've got an edge in the market and it's a system that makes money, you'll make money because you're just simply filling out your spreadsheet, taking the trades. And that's your only goal. If you keep the risk really nice and low and you don't over leverage or over risk on the trades, there shouldn't be really any emotional elements there. You're just taking low risk trades, filling out the spreadsheet, and there's a probable outcome to that. It's like I just said there. So you just execute, collect the data, and the P&L follows. So another chart here, and I just want to show you a little bit with what we do, because I still trade basic supply and demand concepts. So the way that we trade could be taught honestly to a child. We use very, very simple levels within the market at round numbers and 50s. And this is a US oil, it's the spot price, the CFD price. But you can see there where I've put the arrow that oil on the spot price was $67 a barrel. So there was a a potential area of demand there that we were interested in buying. Now, as price came down to that level, I'm looking at the average true range, and we can see that if I take that trade on the day, my stop loss is going to be further away than or beyond the average true range. The average true range is basically, if you don't know what that is, it's just simply the average move on the day. So this is the daily ATR. It's telling you over the last 14 days, what's the average move been? Well, I could enter this trade for a buy limit order on that level, and I could get my stop loss safely beyond the ATR. Now, the trade I know already had a 70% chance of working. But if I get my stop loss beyond ATR, I know from my data that it's now got a 77% chance of working. So the edges, the odds are stacking in my favor, and I've clearly got an edge here. I have to take this trade. I had to take it at 70% because I know it's profitable. I have to take it at 77, and I have even more conviction because I have the data to tell me that this level is probable. It's likely to work. So as the trade pushed down, it reacted, it banked the 1.5R, whatever we were looking for on that particular trade. The stop loss was outside of ATR, and it did a small amount of drawdown, which we would log, and then we would log as well the unrealized gain. So how far did this then go? Did it go all the way back up to here, or did it simply do the 1.5R, then break down? But all that gets logged. Now, the fact that that one trade won is completely irrelevant. It's one trade, and it doesn't mean anything. Your conclusions need to be drawn from hundreds of trades. My edge is built over thousands of trades of data. And I really try and move traders away from that win-loss terminology, because we attach our emotions to those terms. A loss we see as bad, but really a loss is inevitable. It's part of the system. It has to happen as a trader. So we don't need to think in win-loss terminology. Result A or result B is a great way to teach a new trader. Result A is a win, result B is a loss. Let's move to those and think about every trade is either going to have a result A or result B. And if we're trading at a higher strike rate, we would want more result A's than result B's. It's as simple as that. So we'll look quickly at a euro US dollar level, and that gave us a result B. So that would be a loss, essentially. Now, I know that this level here had a 77% chance of winning based on the previous quarter's data with the same setup. Again, we're at that round number, so it's 108. It's the spot price. I'm looking at selling that level, so a sell limit as we get up there. The actual entry itself now, this time, is 87 pips outside of the ATR. So last time we had the stop loss beyond the ATR. This time we've got the entry beyond the ATR. So this is an even more extreme push into the zone. And the chance of a mean reversion here, the chance of this coming back down is 88%. It's high. What happens? The trade spikes a tight stop loss before it drops. Result B, so it's a loss. But again, it's completely irrelevant. It doesn't matter. That one trade just forms part of a bigger data set, which gives us our edge. The other thing that I want to go on to now is, based on all the stuff we've been talking about so far, is psychology and win rates. So you'll see a lot of traders that teach an edge, which is a very high risk reward. So you get a high strike rate, low R is one type of edge, which is how I would say I trade. Or you have a lower strike rate with a higher R, higher reward multiple. So you could have a win rate of, say, 30% with a system that makes 1 to 5 on average. It's a profitable system, but it's a lower strike rate. And there are many, many traders that trade with high win rates, and there are many that trade with low win rates and high risk reward. But I don't think it's the best way to go for the new trader, and here's why. So this system here is a 30% strike rate, as I just mentioned, a 1.5 risk reward, 1 to 5, sorry, risk reward. So for every 1% I risk on a trade, I want to make 5. Now, this just shows the consecutive losses. So the average consecutive losses of this system, and this is 10,000 experiments of 1,000 trades. The average is 17.1 consecutive losses. That's losses in a row. The 95th percentile of experiments saw a 24 trade losing streak, and the max was 42. So if we take the average, 17.1 losses, how does the new trader feel losing 17 trades in a row? They're probably going to give up. They're probably going to strategy hop. They'll think this system isn't for me or it doesn't work, and they'll go round in circles for years because all they need to do was continue to execute this system. There's an edge there, it makes money, but they didn't, because they saw that huge number of consecutive losses. They lost faith in the system and they went to something else. They changed mentor, they jumped on YouTube, they spent hours back testing trying to find something wrong with the system. There isn't anything wrong with it, but it's really difficult for the new trader to trade through those periods. But if you actually look at the expectancy of that system, so 10 trades per month, so total trades in 12 months is 120 trades. No compounding here, it's just 10 trades every month. That system, let's say, take the middle one at 0.5% risk per trade, it makes 48% in 12 months. So it's a hugely profitable system. And you put yourself in the top 1% of traders executing it, but you have to potentially face 17 losses in a row. Very difficult for the new trader. In my experience, I have not met a new trader that could go through that successfully. The flip side is that the higher win rate, but lower R. So now we're looking at 75% win rate, but a 1 to 1.5 risk reward. And you can see that we've got a massive drop now in the number of consecutive losses. So the average is 4.7. Even I've had people leave my community when I've lost 3 trades in a row. So, because they think that the system doesn't work. But you can see even with the 75% win rate, there was a 10 consecutive loss on one experiment here. So you could see a number of losses. And it's so important to know this about your system. If you don't know what your potential consecutive losses are, then how do you know what's normal or what to expect if you start going through a string of losses? You don't want that self-doubt to creep in, or your doubt in the system. You want to know that this is just part of it. Maybe I've hit 5 consecutive losses in a row. I know that's the average. I just need to keep executing. But if I don't have that data, it just brings questions. You start to think, am I doing this correctly? Am I executing the system wrong? Does the system still work in these environments? There's so many things that come up from it. And it's amazing how many traders don't know this information about their system. Now, if we look at the expectancy of that system, let's take the middle one again, risking 0.5% per trade, 52.5% return in 12 months, 10 trades per month. It's the same thing. We're roughly 50% in the year, same as the last system. But the difference is now we don't have to face a string of 17 losses. We just have a string of a potential 5 on average, that is. A lot easier for the new trader to handle. And that's what I talk about here. So, while 1 to 5 is profitable, and many great traders use this, I know traders that are hugely successful that push their risk reward to 1 to 20, 1 to 30 and beyond. Average R of perhaps 1 to 12 even. And they're great traders, but there's 2 things with that. One is that they have been trading for a long time. They know their data. They know what to expect in terms of consecutive losses, and they have confidence and conviction because they've traded through those periods before. But for the new trader, it just leaves doubt. So a higher strike rate is easier for the new trader to trust. And it goes back again to what we said earlier in this presentation, which is early confidence comes from seeing the system work. You start to see the system work. I see it every day. I've had a mentee even send me some results this morning, just seeing the probability work. He's up 10R this week alone, and that 10R is just starting to prove to him that the system makes money as you execute it. So yeah, hopefully I haven't bombarded you guys too much with my kind of data-driven approach, but I think it's something that's massively overlooked in the retail space. If you go to any professional trader and you ask them about their system, they can tell you everything about it, in terms of consecutive losses, win rate, average drawdown, etc. The retail traders, it tends to be common that they just kind of turn up at the markets, don't really have anything, any data. They don't have any statistics around their edge that they can quote you. When they're getting a trade, you really want to know, what's my percentage chance of this trade working? If you're not sure as the market approaches the level, then the chances are you're not going to have that confidence and conviction in your edge. And this is some just really general stuff, but it's basic, but follow the system, not the emotions. If you have a system that's based on you taking every single trade, you have to follow it. If we have a 77% win rate across 100 trades, we have to take every one of those 100 trades. We can't pick and choose the ones we want to take because we think that one's going to work better than the other. We have to take every single one because we know that the 77% comes from taking every trade. It doesn't come from picking and choosing or turning up one day and then sleeping in the next. Routine is hugely important here as well. Probabilities, so Tom Hogarth famously says that we have no idea what the next trade is going to do, but we do have an idea of what the next 100 trades are going to do. And we need to remember that when we're executing the system. It's the old classic Mark Douglas quote: anything can happen. When you take a trade, anything can happen. But over the course of 100 trades, we have an idea of the sort of money we're going to make. And data is everything. Track it, refine the edge, build your data. If you've got data, then you've got something to fall back on. You've got that conviction, and it gives you a focus. Filling out the spreadsheet every day, turning up, filling out the spreadsheet. Before long, the profit and loss will follow. And as I've actually capped the 3% club at a certain number of members, but speaking to Simon as well, I am also happy to chat to any of you guys that are interested in joining our small community. I keep the community relatively small because I don't want to grow it to huge numbers where we get bombarded with a chat going off all day about random things like the football on the weekend or who won the UFC. It's purely about trading. We're data-driven traders, and we've got a number of traders in the group now that are full-time, many of which are funded through these retail prop firms as well. And we just execute together every day. So we trade within the community together every single day. But that's it, guys. That's kind of me done with the data side of things. Hopefully you took something from that.
Thank you, Dan. Yeah, fantastic. Now we've got some time for questions and answers, and also maybe time for. I thought you might be able to look at one or two of the markets for us since the beginning of the day. So, guys, if you can have a think about some questions, and just for the next few minutes, I'm going to ask Dan to just see if you can share a chart and see what's happening. So I think there is a bit of activity today. What is
Absolutely.
it?
Yep.
Do you have any trades on yourself?
Nothing this morning. So we missed. I'll talk you through it. Let me share my. I've got some mad colors at the moment going on with my my chart. So one sec.
Mad colors. That can be good or bad.
Here we go. You see that? Okay.
We do. Thank you.
Yeah. So we sold the high of the week this week. So we sold pound US dollar on Bank Holiday Monday at the high of the week. Again, if I go back to why we sold that, it was a simple supply zone. So we pushed into a supply zone at 135.94. So that area is again around our round number of 136. So we're looking for a reaction there. I trade the FX majors predominantly with a few other things as well, futures markets, but pound US dollar hit that level. And something that we use within the community is cross-currency correlation. So when we hit that level, if I go back to it, which was here, you can see exactly what happened at the same time on Euro US dollar. We hit an area of supply. Aussie dollar US dollar, that also hit this area of supply up here. Same time, you can see that. So we made the high on the week across all the dollar crosses at the exact same time. That's what we look for. And then I was actually out last night when the guys in the group took Aussie dollar, which I think some of them are here with us in the presentation or watching this as well. They took the Aussie dollar US dollar long, so they took the low of the week so far as well, which again we pushed into that area of demand. Similar concept, New Zealand dollar US dollar was pushing into an area of demand here. We had the dollar index at the same time that was pushing up to, at the time they were looking at it, this area here, which was breached on the tariff news on the gap, but we don't trade the Dixie. We use it for confluence with our majors. And overnight, if you look at the markets, I mean, you'll start to see this happen all the time, but I favor trading currency because I like to look at the market as one entity. And we do, while we have a tick box process within the community, looking at the markets as a whole, is something that I think traders miss. I think that they draw all this analysis on something like, let's say, the US dollar CAD, but they don't understand why we're at the level. If we've drawn a level of supply and we've pushed to that level of supply, there's a few reasons why we could be there. We could be there because the dollar's strong. We could be there because the Canadian dollar's weak. We could be there because there's an oil move which is carrying across to an inverse correlation to the loonie. So we can end up getting to levels and not understanding why we're at the level. If we understand what's driving the market and what's putting it there, then we can form an overall bias on the market rather than just fixating on the technical analysis we've drawn on one asset. So I'm not a big believer in just dialing down on one asset or two assets like a lot of people are. I much prefer to look at the market as kind of one entity and understand what's driving the move and why it's moving. Someone said that they would like to see the Excel sheet. So yeah, I can certainly show you that. If I just bring that over. I might have to stop sharing and reshare because I think I'm sharing a tab rather than the screen.
Yeah, sure. You seem to be navigating your way around the platform, which is great. So it's the first time you've used it, Dan, so well done. Great, I can see your trade journal.
No problem. Yeah, so this is Q2. So we're in the second quarter, obviously, of the year. And this is the kind of data that I log. It's every trade that's been taken, the date. The heat map is something we use in the group. So there's specific things here that I use with my mentees, which I won't go too much into, but things like ATR, was the trade valid or invalid based on certain criteria and rules we have. I'm actually working with a trader at the moment, a couple of traders actually that have their own edge. They trade their own way, but they don't have any data on their edge. So we're working together every Friday to quantify their edge and build a spreadsheet, build the data, so we can start to tweak things. Average drawdown, were these overnight holds? Don't typically overnight hold. Was the level visible on the daily time frame? Because we tend to be higher time frame traders. When I learned from Robert Dunn, he spent most of his time on the daily charts, and he was on the floor of the CME, executing every day. So this kind of stuff about people trading 15-minute time frames and stuff, I don't know how long that will last, but for me, I can't do it. I certainly can't trade the lower time frames. I've got more conviction and I've got an edge on the higher time frames. There's nothing that needs to be changed. But that just gives you an idea. I log a lot of data, and I also use Notion to log data as well, where I screenshot things, and I sometimes will focus specifically. Picking areas of supply and demand. Yeah, sure. I'll show you guys that as well. So, I don't want to give too much away in terms of my edge, just out of fairness to the guys I trade with.
Yeah, it's all sort of fine balance. You run obviously the group. They'll get a bit miffed off if you're revealing it all.
That's fine. In terms of supply and demand, if we're looking at a market, I'm looking at areas that the market has either this, for example, we've got a drop, a base, and a drop. That's a clear area of supply there because there was an influx of orders before an excessive move away from that zone. If we look at something like pound US dollar, for example, this area here would have been an area of supply. This area here would have been an area of supply. You can see there's small reactions to these. I'm not necessarily looking for the market to change direction. I've always said that there's 7-point-something trillion pounds traded or dollars traded every day in the currency markets. We don't need a slice of that pie. We just need a crumb, just a crumb. And if we find an area of higher time frame supply or demand, the market pushes in, and there's a small reaction, the chances are we've made, with the right parameters based on our data, we've made anything between 1 to 1.5 or 2R. Some of the guys in the group push that R a little further even than that, upwards of 2.5, 3R. It's really interesting in this month's data, the sheet I just showed you, pretty much I'd say 8 out of my last 10 trades have done 1 to 5R, but I've not taken 1 to 5R on any of them. So I'm recognizing at the moment how much I'm leaving on the table in terms of trades. The other thing to think about there as well is that even though I'm recognizing that now, that's only in the short term, that's only this month. So we won't make any changes, or we won't refine or change anything until the end of the month, until the end of the quarter. So we never change anything in the group until the quarter's over. When we get to the end of the quarter, we should have enough data. Anything between Q1 of this year, I think had 140 trades logged. So that gave me enough conviction to say we need to start pushing the risk reward here, or we need to trim down the stop loss on average. But we won't make short-term decisions, or we won't make decisions based on short-term data. It's always over a number of trades, a large number of trades. And yeah, I am an intraday trader. So although we do occasionally hold overnight, my trades, we're in and out pretty quickly. I think the guys yesterday, I was out for dinner, but they took an Aussie dollar, US dollar long, and that was closed. The last person closed it, I think, this morning. Justina, she closed it this morning for 1.6R. A few of the other guys closed it last night just before spread. So you guys could contact me on LinkedIn. I think LinkedIn is probably the best way. I don't do any of the kind of Instagram stuff and that. It's not really the right platform for what I'm trying to promote. I mean, how appealing is it on Instagram to see a bunch of spreadsheets and equity curves and things? It's probably not the right place. So I tend to do LinkedIn, and it's just my full name, Daniel Monday, on LinkedIn, and you can find the 3% Club on there as well. Training wise, yeah, do everything through the Discord server. Perfect, thanks. I look forward to hearing from you. Yeah, I do everything through our Discord server. So our community has my whole edge is taught in a video course. So everything's put into a video format to teach you how to trade the edge. And then essentially you execute with us. So I do a weekly outlook every Sunday. I post my charts at the start of the week. And then I have a live market updates channel where I talk about exactly what I'm looking for, what I'm wanting to see in the next hour or so as a trade's approaching, And what you tend to find is the guys in the traders chat, they all talk together. So we've got a number of very, very good traders in there, and you get to know who's very good. And you talk about a potential setup that's coming in. And more often than not, it's just the group saying, yeah, I'm in. Loads of people are just sending the thumbs up to say they're in the position. And then when the result happens, whether it's a win or a loss, they post the result. Everybody's really transparent. There's no sort of ego stuff in there. It's not about sharing P&L screenshots or anything. We celebrate a win. We celebrate if somebody's got to X amount of funding or big milestones, but we don't sort of glorify MT4 screenshots of 10 grand profit or stuff like that. It's not what we're trying to promote. We're trying to promote long-term profitable trading.
On that, funding, is everybody trading with a prop firm, or the trading with a funded account? And
yeah, I've had a few go full time this year with FTMO.
okay.
I don't normally like to sort of list all the firms we're using, because I had a bad experience there where I was using the My Forex funds. I don't know if you remember them.
Yeah, rings a bell.
Yeah,
Yeah.
so I had a $200,000 account with them, and while I didn't lose any money because I had payouts, I still equally lost an income stream there. And I was saying you can't really go wrong. They've got the market cap at the moment; they're the biggest firm. Then all of a sudden they disappeared overnight. So I think as long as you know what you're getting into with that, and you accept that the money that you put in for the challenge, the fee, is all that you're risking, really, then it's a great avenue. I can't see why people badmouth them so much, because I've got people in the group. I'm consistently paid by prop firms. I have been by loads of them, and I've got people in the group that have been paid by FTMO, for example, since 2021, consistently on the same accounts.
Yeah.
Sam, one of my mentees with max allocation, he's had 400,000 with FTMO since 2021. So if you stick to the reputable firms, I'm using another firm I don't mind mentioning, is Darwin X Zero. I found them pretty good. They pay me on time. I like the fact that I can build a track record with them as well and share that with people as evidence that I am a profitable trader. Because some people need to see that, and rightly so.
We've got Kieran coming along in 10 minutes, actually, following you from Darwin next year. So yeah,
Oh, good stuff.
they have an interesting flow.
Yeah. So a number of these firms I do rate, and even if you receive a few payouts from a firm and something went wrong with them, perhaps a less reputable one, you've not lost any money. You've still essentially made money from these firms. So yeah, I think that there's a number of good viable options out there, because it used to be, what do you have to invest? And people would say, well, I've got 5 grand, and you'd say, well, you're not really going to do much with 5 grand. There's no point really starting. You may as well just learn on the sidelines until you've got a bit more capital. But now it's like, well, you just need to put in, with Darwin, for example, you just need to pay the monthly subscription, which is really affordable, and you potentially got access to earning.
Darwin X, yeah. I mean, I'm hearing more and more people discussing prop firms as even just a great tool for training. Is for us doing a sort of trader assessment. One or two educators that I've been working with, um, they say, well, let's do a trading challenge, because it gives them a great opportunity to monitor the trading and say, right, this person needs, let's start from the beginning, or actually they've got a keen eye on risk management. They kind of got a good idea. So we just need to focus on this and this and this.
Mm,
So
mm.
it's a useful system
Yeah,
from this
I've been
point of view.
putting together. I've been putting together a little thing for September, when I speak at the Prop Expo, and I've got a number of mentees that are going to come with me, which I'll be able to use some of their data and their experiences with prop firms, which would be good. But also,
It's
there's only
going to
two
be
reasons. Yeah, there's only two reasons why you fail a prop firm. One is you don't have an edge, or two is you over leverage. Or one, if you don't have an edge, you shouldn't even be trading them. You need to find an edge first. And two, if you're over leveraging, it's because what we just went through. You don't know your system. If you know your max consecutive losses, then you know what your risk needs to be every trade, or you're never going to get near those maximum drawdown parameters.
I mean, do you aim to take away? Well, this year we've had Trump markets, haven't we? I mean, it's still going on. You wake up in the middle of the night, something's happened at the White House, and it can cause markets to go crazy. Are you trying to take away all the impact of these fundamentals, and try and reduce them? I mean, or can you? You have to sort of factor that X factor in, don't you? This,
You do, yeah. I mean, I like it. I like the volatility. The time I don't make money is when the market's not moving.
yeah.
So if there's volatility, and especially being a mean reversion trader, I'm looking for the market to push one way and revert back, and we're getting that a lot. We're getting so much chop, and that's perfect for us at the moment. So one thing you find is that the scheduled data releases do very little. Something like CPI, which used to be, or even retail sales. I can remember 2016 through Brexit negotiations, and every morning you'd wake up to some 100 pip swing on cable because there was something going on with the pound, or there'd be retail sales that would move the market 70, 80 pips. Now it barely flinches from any of that. It doesn't care anymore. That's a
Non-farm
post-COVID
payroll.
thing.
Every day is a news event, with Trump in the White
Yeah,
House.
yeah. Sometimes
It's
we're just sat waiting for him to say something. And the market's gone flat, and eventually he says something, and off we go. It happened last night, 2 a.m. So a big push on a big move on all the dollar pairs, ES, Dow Jones, everything moved, crude oil, and then obviously woke up to the big candles this morning. But unfortunately, I wasn't awake to do anything with it.
Well, I hope I'm not costing you money now by by doing this
Not at all. No,
presentation.
no.
It's been great chatting to you. Just typically, how long do you spend at the screen in a day, Dan? Are you?
Um, I can I could get pretty obsessed with it because I love it and I enjoy it. But I try to limit my time, so it tends to be. And when I teach trader, there's a couple of ways I do it, depending on whether their job's very full on. If they've got a full on job, we have a process to execute the trades in a certain way using limit orders. But for me, I tend to be on the charts because I'm mentoring a little bit more. Um, I would probably say strictly for trading, it's an hour in the morning, an hour pre New York, and an hour perhaps late New York session, and that would be it. You know, 3 hours a
Yeah,
day, something like that.
yeah, and you'll trade from your desktop. You won't trade from your phone.
I will
Are you?
trade from a phone if I have to. It's
No.
not ideal. I don't want to have to do that, but if something arises, you get quite in tune with the markets, and many of you guys will probably find the same thing. but you go to bed knowing where the price the assets you're trading is. And the first thing I do when I wake up is check the price of where those assets are. And I can tell you, okay, through Asia we've not done anything, or through Asia there's been a big move. And I know I've got an idea of what I want to see happen before it happens. So if that's on the phone, you can check it. It's not ideal, but it's all about pre-planning and making sure you've got the analysis in place in the first place.
Fantastic. Well, this is great to have you on. So a lot of good content out there. You were introduced to me as well by Nick Penrave, that does the fabulous A Trader's Life podcast.
Yeah.
So if anybody wants to listen to that podcast with Dan, I thought it was fantastic. You're majoring on trader psychology, I think, during that conversation. You can find that at the I don't know where you find it. A Trader's Life is called
Yeah,
podcast
it's
with.
on YouTube. You could just search my name and you find, or it's actually on the homepage of my website. I think that one, which is just the 3%club.co.uk. It's three and then percent as a word, not a symbol, obviously. So the 3%club.co.uk.
You said that a few times already, haven't you?
Yeah, I have. Yeah, yeah. Yeah, I mean,
Fantastic.
I've capped the membership, so I don't want to sort of plug it, but equally, people that are coming through you, Simon, because I only take referrals now. But I would accept, anyone that came through this is essentially a referral from you. So, more than happy to bring some new people, new faces in.
Bring some people on board. Fantastic. Does anybody have any last questions for Dan? There's been some good questions already. Do you classify yourself as an intraday trader? I think we covered that. You showed the spreadsheet where you record and monitor your trades. Charles, yes, he talked about the supply and demand. So fantastic. Well, I really appreciate you giving up the time, Dan, especially as I only called you yesterday morning and said, help. Ross
It's
is
fine.
ill.
No,
You can step in. So it's been great. We'll have Ross Maxwell back next month. By the way, folks, if you were coming hoping to see Ross I think you got a good deal though. Dan's been fantastic. I really appreciate it. So we'll let you go and get back to your group and the markets, and we're going to continue with Kieran, who's here as well, Kieran Duff, who is the head of growth at Darwin X Zero in the UK. So I'm going to see if I can remember how to close this. I'm going to pull everybody into the next session. So at the left hand side of the schedule tab there, we click on that new section. It opens up a new webinar. So Daniel Munday from the 3% Club, thank you so much for joining us.
thanks, guys. Thanks, Simon. Thanks very much.
Very nice.